Hi there, welcome to Market Call. We are talking real estate and real estate investment trusts, real estate equities with Andrew Moffs of Vision Capital. Andrew, thank you so much indeed for joining us. Well, we know there's going to be some changes. You're going to get loads of calls on retail. We won't steal your thunder on that, but basically real estate, we're going to be into a new era, presumably, after this pandemic.
Yeah, first of all, thanks for having me on. And certainly, we've seen tremendous volatility. You think about the month of March and, just the S&P 500 alone, you saw on average daily moves of 4.8%. Real estate was not left behind in that. The volatility was there in the real estate world. But what we realized and what we saw was when we came out of March and we saw the discounts in an asset value of, call it 40%, we don't believe the private markets have traded off that much, but it goes back to your point that people have a longer term view coming out of this, how they think real estate will look coming out of this. We think at least the stocks have priced in too much of that.
Just amazing stuff, I suppose. And I know you're probably going to touch on this during the show, but real estate, very much a creature of interest rates. It basically is good for real estate investors when interest rates are low. Do you think they are going to stay low for quite a while?
I mean, we've seen these are, I'm sure the word unprecedented has been used several times on your program. These are unprecedented times, yes. And what we've seen is unprecedented stimulus by governments globally. And as a result, without a doubt, interest rates will remain low. The key question you're asking is, well, what are the ramifications of low interest rates on real estate? And, I could present a couple scenarios for you where high interest rates could still be good for real estate and low interest rates could be good for real estate. It's really about the supply and demand. And interest rates are almost secondary in the valuation equation.
We are going to take a break. Andrew Moffs of Vision Capital taking your questions on real estate stocks and real estate investment trusts today. The number to call, 1-855-326-6266, or email us marketcall@bnn.ca, or put your question on Twitter @marketcall. We'll be right back. It's an email from Robin, wants to know about Invesque. Would you remind us, Andrew, what does Invesque do and what do you think of it?
So Invesque is a healthcare REIT. Its focus is across the spectrum of healthcare, whether it's skilled nursing facilities, medical office buildings. They operate more so in the United States. They have a presence here in Canada. It's a name, we think management is talented. They've been very creative. That said, they are in a very tough spot today. I believe that this company, they've had to suspend their distribution because their leverage is too high. And in this uncertain environment, what's happening is their operators, when you have seniors facilities in the United States that might be private pay, they've had some difficulty collecting rents.
So is this one you'd avoid for now?
Absolutely. I think in this environment, we are certainly taking the view that you want to focus on quality, liquidity, and you don't necessarily have to go too far down the value chain to find that in this discounted environment.
Ninas has sent us an email, wants to know about H&R REIT. Now, we have of late seen the yield on that one go pretty high.
Yeah, so H&R, strong management, one of the oldest REITs in Canada, diversified company, and it's gotten into trouble in the public markets because of two things about their portfolio. One is their retail portfolio, the Primaris portfolio, the mall portfolio that they acquired several years ago. And second is the Bow in Calgary, their office building that has a long-term lease to the former Encana. Firstly on retail, On the mall side, we've seen all the headlines in terms of rent collection. At best, you're seeing 20% rent collection in the regional malls. I think Unibail, Rodamco, Westfield, they're one of the world's largest mall owners. They reported that last night, and we've seen similar numbers out of the Canadian pension funds. The reality is H&R's done a little better actually on rent collection, but the reality is coming into this, we were negative on retail. So there is a risk both in terms to their distribution that is quite high right now in terms of both the mall portfolio as well as this long-term lease they have on the former Encana building in Calgary, which is over 12% of their net operating income. If you see any opportunity when to purchase H&R, it'll probably either come after a distribution cut or once we see a much more normalized environment, because at this point it is heavily discounted, but it's, again, a name we tend to avoid. They have a very good residential portfolio. Their industrial portfolio is good, but they have too much retail and office exposure for us today.
So the yield has gone out to about 13%, and you think a cut could well be in the offing?
It's possible, certainly. I think, yeah, go ahead.
Okay, sorry. Okay, thanks very much. And H&R, giant REIT, of course. We have a caller, Stephen in Calgary. Go ahead, please.
Hi there, Andy. First-rate show. Andrew, I wanted to ask if European Residential REIT is still collecting their historical percentage of rents from tenants despite COVID-19. And are multifamily REITs new to the Netherlands, and what are the supply-demand fundamentals like? Thanks.
Yeah, so ERE, that's a stock we own. We think very highly of management. They're externally managed by Cap REIT, Canadian Apartment REIT here in Canada. They are the only REIT globally focused on the Netherlands. The Netherlands is a very strong residential market. It's actually one of the most dense populations in Europe, and with no new supply. So you couple growing demand, no new supply in any industry, that's a good thing. It's a highly regulated industry, so they have rent control just like we do here in Ontario. And CAPREIT's been very adept at moving rents according to the regime here in Canada and Ontario specifically. They've been able to navigate the Netherlands pretty well. So as it relates to ERE, here's a stock trading at 15-20% discount to net asset value, where they're seeing rent growth. And to your point, they're one of the new entrants in the space. They're by far the largest consolidator of what was previously a mom and pop business. So we like this company a lot.
I'm sorry, is it residential real estate in Holland?
Correct. Yes, apartments.
Oh, okay, grand. Oh, okay. And I wish I was in Holland many years ago. Loved it. Wish I could get back there. Adam in Toronto, go ahead, please.
Hi there. I have a question about BTB Real Estate Investment Trust. Do you think the dividend is safe? How do you think it stacks up against competitors like Granite, for example? And if you had to estimate a one-year price target, what would you think? Thank you.
BTB.
Yeah, so BTB, this is a diversified REIT focused in the Quebec market. Excuse me. Small market cap, focused on secondary markets in Quebec, probably about 65 or so assets. What we don't like about the company is it's focused on retail and office. Together, that's probably about 3/4 of the portfolio. I am concerned about the distribution yield. It's high, but the reality is they don't cover it, meaning their earnings don't cover that distribution. So anytime you have a company that's focused on the wrong, necessarily, we'd say focused on the wrong sectors, and they don't cover their distribution, I think you're at risk for a cut. And hence, I don't really see much price appreciation in the stock. People tend to own this for the yield, and at this point in this environment, I think the yield could be at risk.
Our guest today is Andrew Moffs. He's taking your questions on real estate stocks and REITs. We'll be right back. You're watching Market Call. Peter is standing by in Vancouver. Go ahead, please.
Oh, thank you for taking my call.
Pleasure.
You and your colleague are the best REIT guy. I love your tip on BSR. Today I will ask you about Sienna Senior Living. Do they have any virus? Because the other one, CSH Chartwell, has virus in their care home. Thank you very much, Andrew. All the best. Keep safe, both of you.
Thank you, Peter.
Thanks, Peter, and thank you for that. So Sienna Senior Living is an operator in this nursing home business as well as in the retirement business. Think about their business. Just over half of it is in the nursing long-term care facility business. We think very highly of Sienna management, the board. We own this stock. The sad reality of the pandemic is, yes, they have been affected by it. I think it's a majority of long-term care facilities in this country have been affected by it. They have the protocols in place to deal with it, and they've done so effectively. The reality is this business is government funded. The residents, their stay is paid for by the Ontario government. You have 30,000 individuals waiting to get into these facilities, and it's really a decision of need. It's not really a discretionary service. So when things normalize, and even through this pandemic, occupancies are very high, and we do believe that will continue. The distribution yield is safe, and we think there's a value mismatch in this company. We think it's certainly undervalued, and we think they have a retirement business, which certainly in the short term, over the next year, we might see occupancies come down. That shouldn't be a surprise, but in the long term, the demographics say that this is the right place to be. So we think Sienna is certainly a buy at these prices.
And certainly, I've just been checking their website. They do report that COVID-19 cases have been reported in 13 or 14 of their properties. It's just cut a tragic sway through that whole sector. Ron in Toronto, go ahead, please.
Hey guys, thank you for taking my call. I have two questions on Canadian REITs. I own Killam Apartment at around $17. I wanted to know your opinion on that as a long-term investment. And second being, which Canadian REIT do you think has the most potential for future after the COVID-19 thing gets over? Thank you.
Okay, he kind of rolled in two questions there. Andrew, I'll leave it up to you.
Sure. Okay. So Killam Apartment REIT focused more on in Eastern Canada and the Maritimes, and with a growing presence here in Ontario and Alberta. We like this company. Like most REITs in the multifamily space, has sold off coming out of the pandemic. And we think the multifamily space is certainly a sector you want to be invested in. At this point, Killam trades at a decent discount to its net asset value, and we think it's sold off too much. And so we think it's certainly a buy at this stage. In terms of top picks coming out of the show, I guess we'll leave it to Andy later in the show. We can review those.
That's right. That's right. In the final block of the show, we're going to get your three of your top real estate ideas. Let's talk retail. We've got Wine in Kingston. Go ahead, please.
Yes. Good afternoon. Would you give me your opinion on RioCan? I know, and the dividend. Do you think it's sustainable? I know the low is around $12 and something, and the high was around 27. What's your thoughts on it, please? Thank you.
RioCan's a great company, focused on retail and with a growing portfolio in multifamily as well as some office as well. And they've really reoriented their portfolio to the major markets here in Canada over the past several years and done a very good job of it. If there's a management team that's going to be opportunistic in thinking about strategy, this is certainly it. You know, Ed Sunshine, we've seen him on the show. I think he was on the on BNN this week, and he has a very good perspective. That said, the stock is in the retail sector, and no doubt coming out of this, we were not bullish on the retail sector coming in. In fact, our funds had been short retail for several years, and it's not really a stock that we would own in this environment. It certainly trades at a wide discount. I do believe the distribution is safe. Thus, if you own it and you have a longer term view, you'd hold on to it. But I see more value elsewhere in terms of growth coming out of this.
I'm looking at a yield on tmxmoney.com right now of 8.7%. It may be a little higher now, maybe because the stock is down around 4% in trading today. That was an extraordinary interview actually with Ed Sunshine, the boss of RioCan. It's on our website, BNN, Bloomberg.ca. He was critical of some tenants, he said, are reluctant to pay rent, even though he said they have pretty big financial resources. It's a great interview. You should watch it. Colin in Sarnia, Ontario. Go ahead, please.
Yeah, good afternoon, Andrews both. Hope you're staying safe at home. My question's about BAM. And I got it on a low bid, but now I'm wondering if, because it's struggling now to basically gain some momentum, if really their revenues are going to fall fairly drastically in the next couple of quarters. So tell me what you think about the parent Brookfield Asset Management, please. Thank you.
Thanks, Colin.
Yeah, so Brookfield Asset Management is probably the preeminent alternative asset manager here in Canada and, quite frankly, globally. They have quite a bit of capital to put to work, and this is the environment you'd like to see that happen in, and they certainly will take advantage of it. Their capital is both to be invested in real estate, renewable energy, private equity, infrastructure, really all the alternative asset classes that have been desired by their LP investors globally. We think highly of management. This is probably the environment where you want to be invested alongside of them, but there's going to be a lot of volatility along the way. And, they do get caught up in headlines. Their large investment in Brookfield Property Partners is certainly in focus because Brookfield Property Partners owns a large stake in General Growth Properties, the mall company. So there are negative headlines that do get caught up with BAM, but we do like the stock. If you own it, I'd continue to hold it.
We're going to take a break. Andrew Moffs of Vision Capital is taking your questions today on real estate stocks and REITs. The number to call, 1-855-326-6266. Let's get to those past picks. And now Andrew was on our show March 5th of last year. And of course, there's been market turmoil, to put it mildly, since then. Storage Vault was your first idea, down 20%.
Yeah, I mean, it's hard to believe it's only been 2 months since those picks, and feels like a lifetime. So Storage Vault, we still own. We think this is a great company, a great sector, the self-storage sector here in Canada. They're the largest owner of it, a consolidator and a great operator. This pick falls into the category of recession resilient. We had the thought coming into the year that the economy would be slowing down, and we certainly didn't anticipate this, but this business is really more predicated on life events, death, divorce, move in, move out, and we still think it's undervalued and has a lot of growth potential.
And just to clarify, I don't know if I misspoke. These are from just a few weeks ago, March 5th. These picks are March 5th of this year. Tricon Capital, the player in U.S. residential real estate, down 28%.
So Tricon operates in two sectors. They operate primarily in the single-family residential for rent sector, where they buy single-family homes in the U.S. Sunbelt and rent them out. We think this is a highly defensive sector. We like it a lot, and we continue to own this stock. They also own multifamily in the U.S. Sunbelt. They just bought a portfolio of that, of apartment buildings that are very synergistic to the SFR business. as well as they have a land business, which doesn't really contribute a whole lot to the value today. What we like a lot about this company, again, recession resilient. They are in the right sectors, right segment in terms of rental in the U.S. Sunbelt, which is the growing part of the United States. And at the same time, they focus on the middle market, and they have very affordable rents. And I think that is the key as we enter a recession. You really want to focus on those companies that their businesses are resilient and everyone needs a place to live. So we like this company a lot. It has sold off because the market interprets their leverage as too high, that they have too much debt. And we think it's certainly manageable. They have the liquidity to get through it. And this is a very talented management team that can operate.
And just remind us, what regions is Tricon mainly active?
So I mentioned the U.S. Sunbelt. There's a significant presence in Texas, for example, but all across southern states from Florida right across.
And then finally, BSR REIT. It's another of these rental plays. This one losing altitude, down 26%.
Yeah, so BSR REIT really falls in our sweet spot at Vision. Why I say that is because it's a U.S. REIT, exclusively focused on U.S. assets, but listed here in Toronto. Hence, automatically, there's going to be an arbitrage to take advantage of, and then that's what we're here to do. BSR REIT, similar to Tricon, focuses on affordable rents in the U.S. Sunbelt. There are 3 states that they focus in on are Texas, Oklahoma, and Arkansas. I've toured every single one of their assets. I think they're run very well. Management is very sophisticated and highly aligned. They own, 50% of the ownership is in management's hands. So you are aligned with the management team. We think it is significantly undervalued. This is a company that the implied cap rate of it is a 6% cap rate, call it, and we've seen trades in the 5% range. Hence, we think it's materially undervalued, at least a 30% discount to net asset value.
Okay. We are going to take a break. Andrew Moffs of Vision Capital taking your questions on real estate, stocks and REITs. The number to call, 1-855-326-6266. Carl in Toronto. Go ahead, please.
Hi, Andy. Thanks for taking my call. Andrew,
Pleasure.
I know you've been a fan in the past of Minto Apartment REIT, and like everything else, it was crushed in the meltdown in March. But unlike some of its contemporaries, it hasn't really bounced back that much since then. The stock price is hovering, just over $20, whereas it was around 28 less than 2 months ago. So I'd appreciate your analysis of how the company is dealing with COVID and its prospects going forward. Thank you very much. Stay safe. Cheers.
Thanks. You too.
Thank you. So Minto is an apartment landlord focused primarily here in Ontario, with a growing presence in Quebec, where they have benefited. And when it was hitting its highs, as the caller alluded to, the whole country of Canada has been benefiting from immigration, and as a result, demand for apartment units at a time where supply is at extremely low levels had pushed market rents up significantly, such that Minto's rents were at least 20% below market. We believe, coming out of coronavirus, that you want to be invested in the multifamily space. That said, no sector is going to come out of this unscathed. And the reality is, if you thought this was a sector that was going to generate 4 or 5% same-store net operating income growth year after year, because of all this growth of population growth, foreign students coming to Canada. You're not going to see that necessarily in the next couple of years. So hence, you have to mute some of that growth, and as a result, those expectations of future value are pushed out. So if you own Minto today, it's certainly a hold. I think it's a very capable management team, aligned. The Greenberg family own a substantial stake in the REIT. We think the distribution is certainly very safe, but you will not have the same growth profile that you had previously. Hence, we still think there's value in the company, but it will take a bit longer to reach those highs.
Tim in Vancouver, go ahead, please.
And I know they just put out a release, and they're doing okay on their office and warehouse industrial component, but retail not so well. I know in the past the leverage has been a bit of a concern. Would you think it's worthwhile to start picking away at this one, being that it's cut in half?
Okay, so that was Cominar. We missed the top of his call. Cominar, what's your take, Andrew?
Okay, so Cominar is a diversified REIT, as the caller mentioned, focused mainly in the Quebec markets. And the trouble with the company today is its focus on retail. 35% of the portfolio is in retail in regional malls as well as shopping centers across Quebec. These are good properties, but as I alluded to earlier in the call, was that rent collection has been very weak. And structurally, we think a lot of these assets are going to have a very difficult time coming out of the pandemic. We were negative going into this crisis, and all that we have seen is that e-commerce growth as a percent of retail sales has really taken off, and that's not going to bode well for brick and mortar retail. So that puts Cominar in a tough spot for a substantial part of their asset value. They were already going through a bit of inward change where they were cutting costs out of the business, a management shakeup. I think they've done a very good job. But the reality is it's going to be a lot more difficult to get growth out of this business. They do have a nice industrial portfolio. Their rent collections that they reported for April were a touch lighter than what the market anticipated. But at this point, I think you could find better value elsewhere.
Tony in Calgary, go ahead, please.
Yeah, thanks for taking my call, Andrew.
Pleasure.
I'd like to ask the guest about Plaza REIT. They have some nice anchors there, like, for example, Shoppers. What do you think about Plaza REIT coming up the other side of this storm? Thanks.
Thanks a lot.
Yeah, so Plaza REIT, if you talk about capable management teams, this is certainly one in the retail space, led by Mike Sakuda. They focus on grocery-anchored and necessity-based retail in Ontario and Quebec. It is a small-cap retail REIT. They are just like everyone else in the retail space. It's going to be a tough environment for them to operate. Certainly, we've seen that necessity-based retail has done well, whether, the grocers are seeing increased business, the pharmacies remain open, but you still have inline tenants in those shopping centers that are struggling, that are closed. And hence, it becomes a much more difficult operating environment in terms of rent negotiation going forward. So we think talented, opportunistic management team, but they're going to struggle going forward, and hence it's been a sector that we've just completely avoided.
I mean, broadly speaking, rents, not just them, but not just Plaza, but rent strikes broadly among retailers, among people renting their homes, that's got to be a threat to the sector.
Yeah, I mean, but think of this. There's a very big difference between a rent strike from a residential tenant and a rent strike from a retail tenant. The residential tenant will eventually pay the rent, or they will leave and be replaced. And okay, so now the rents are no longer $1,500; they have to be $1,400. In retail, we still have empty Zellers boxes from 5, 6, 7 years ago. That was pre this crisis. So you had a tenant paying $5, $10, $15 in rent, and your alternative is zero. So I think that is the difference when you think about the different sectors, is that you could have permanent value impairment because retailers either cannot survive in this environment. I mean, you're seeing the large department stores finally enter bankruptcy proceedings, and all that happens is it's just simple demand and supply. If the demand isn't there and there's too much supply, rents have to come down.
Mm-hmm. Yeah, that's amazing. Is it across the country? You will still come across giant stores that used to house Zellers and are now just tumbleweeds.
Yeah, absolutely.
Right. Sign of the times. I think we've got to take a break. Andrew Moffs is taking your questions on real estate, stocks and REITs. We'll be right back. Stefan in Kitchener, Ontario. Go ahead, Stefan.
Hello there, Andrew and Andrew. Thank you for taking my call. I hope you're both staying safe and out of trouble. I just have a question on
Well, I wouldn't go that far, but thanks.
I just have a question on SmartCentres REIT. Would you be a potential buyer right now, or would you wait it out a bit? Thank you.
Thanks a million. SmartCentres.
Yeah, so SmartCentres is a shopping center-focused REIT, primarily leased to Walmart, hence very defensive in terms of the cash flow. Walmart will certainly continue to be a winner coming out of this, as they are pretty adept at both brick and mortar and online. Where you'd have concern, just not unlike any of the other retail REITs, is the inline tenants, if there's any exposure to fashion or any of these tenants that have been closed that are not essential services, it's going to be a tough environment for them. SmartCentres, it's a strong company. They have some very interesting developments, Vaughan Metro Centre here in Toronto, as well as some other assets they can redevelop and intensify. So we think there's a lot of talent there. If you own it, it's probably a hold. But notwithstanding the value, we continue to think you're better off owning those sectors that will do well coming out of this. If we're negative on retail, we're positive on industrial warehouse. I think as we've seen the adoption of e-commerce ever increase, that's where you want to be.
Arthur is standing by in Vancouver. Go ahead, please.
Hi, my question's on Brookfield Property Partners. You mentioned it before, but the question of whether the connection to Brookfield, the international presence, and maybe the ability to adapt will help them to survive this. What do you think?
Thanks very much.
So Brookfield Property Partners, about half their business is in the office space, another half in the mall space, and they have an investment in opportunistically across all real estate classes, probably about 10-15% of their capital. In terms of survival, no doubt, BPY will survive. They are fully backstopped by their parent company, Brookfield Asset Management. So you can take that off your concern list. Brookfield Asset Management has a track record of buying in all of their subsidiaries, whether it was Brookfield Office Properties, BPO, several years ago, or Brookfield Office Canada a couple of years ago, or General Growth Properties 2 years ago. Thus, the value is there. And you have to ask yourself, do I want to own these businesses? We can talk about the office business. We weren't necessarily bulls on the office business coming into this, as densification has only led us to use less and less office space. And then the mall space is just extremely challenged, and parts of the mall sector will never come back. I mean, GGP benefits from having some really trophy malls, which the whole reason Brookfield bought the company was to redevelop some of them, and they will over a longer period of time, and a lot of value will be created. But for their B, and even they have the odd C asset, they will struggle, and hence the value's there. And you are really buying this stock to make a bet that one day Brookfield Asset Management, the parent, is going to come up with a strategy to fix this company that has never traded well in its history. And I think we're at the point now where the market is very sensitive to both its high leverage and the sectors it's in. So it's deeply discounted, very high discount to the net asset value, but with a lot of risks. So if you're willing to go up the risk curve, you can own it. But there, again, as I keep saying, there's other value elsewhere that's probably not as risky.
Gary is standing by in Toronto. Go ahead, please.
Andy and Andrew, thanks for taking my call. Andy, great show as always. Keep up the good work. Andrew.
Oh, thanks.
I'd like your thoughts on American Hotel Properties Income REIT. The price has been moving lower just prior to the pandemic, and it has dropped significantly since then. I'd like your thoughts on, is the yield safe? And what do you think will be the target price in the short and medium term? Should I be adding to the stock or just cut my losses and exit? Thank you so much, and stay safe, both of you.
Thank you.
American Hotel Properties.
Yeah, so AHIP, the acronym, it's a difficult stock to own in this environment. We were negative on the hotel sector generally coming into 2020. You were going to see flat growth at best. And, obviously with the pandemic, hotels have been shut, and we've seen revenue per available room, RevPAR, the often quoted statistic that comes out weekly in the hotel space, down 80-90%. Hence, AHIP has had to cut its distribution. So I don't believe they currently pay a distribution. I think it's been suspended. And we think it's going to have a challenge period coming out of this. So when you have a combination of impaired cash flow and high leverage, that's probably not a good result. And I'd probably move on and invest elsewhere in the space.
The Wall Street Journal had a great feature the other day about people who've leveraged up to buy a bunch of Airbnb properties, took on loads of debt, and they're hurting now, to put it mildly. But Airbnb's been a real headwind for hotels in recent years.
Yeah. I mean, disruption in the hotel space has been ongoing for at least a decade, whether it was, first the Travelocities and Expedias of the world coming in and disintermediating the travel agent. And people would go to their sites over the hotel's website. Then Airbnb was certainly a threat. So there's been a lot of hidden new supply in the hotel space that's really hurt the asking rates for hotels generally coming into the crisis.
Andrea in Brampton, Ontario. Go ahead, please.
Thank you, Andy and Andrew, for taking my call. I have a question on
Pleasure.
Apple Hospitality REIT. Would this be able to sustain, it is a good stock to buy for long term, and would it be able to sustain after the COVID-19?
Thanks very much. So I believe you're asking about Apple Hospitality listed in the United States, ticker APLE. If that's the case, that company, if I had to invest in the hotel space today, that's probably one I would look at, simply because it does have exposure to the more limited service sector of hotels. And if you think about how we're going to recover out of the pandemic, the first travel that you will see will likely be the drive-to traveler, the leisure traveler, people who are willing to, take the risk, as opposed to those that will have to take a long airplane ride to wherever it is across the country and pay higher rents in the upper upscale or luxury sector. So we think Apple should benefit first in terms of their cash flows recovering, because they operate more in the limited service, and as well, their margins are higher. So you're able to absorb lower occupancy for a longer period of time than a luxury hotel, for example, which has to deal with food and beverage, restaurants, catering, conference centers, etc.
We're going to take a break. We'll get Andrew Moffs' top picks right after this. You're watching Market Call. Top pick number one, Andrew, is sticking with BSR REIT.
Yeah, we continue to think this company will benefit during this recovery as their rents are very affordable. $800, $900 rents in key growth markets where we still think job growth can be positive and people need a place to live. So we like this stock. It's heavily discounted. And even trading below its IPO price, as we've seen many times in the past. Companies that are listed here in Canada that own exclusively U.S. assets never have the appropriate valuation. U.S. investors that own multifamily REITs in the United States, they don't look north of the border to buy apartment REITs, and Canadian investors often just simply look at what's the yield or do I have U.S. dollars to invest and don't give it the appropriate value. And again, we think there's a lot of value in this company.
Although they are Dallas-Fort Worth focused. I mean, Texas, their economy is going to suffer in the near term.
Without a doubt, every economy is going to suffer coming through this crisis and coming out of it. GDP growth negative, that hurts all aspects of real estate and all economies. The reality is, though, you then have to talk about this on a relative basis. If I previously was living in New York City, if I have the choice going forward, is that the urban and dense environment I want to live in, or if I can still get a technology job in Austin, Texas, and I can live in a 2-floor apartment building, walk up, I'd probably make that choice if I was able to. So I think that's where BSR benefits from. They're still in the markets with competitive job growth and low tax jurisdictions where a lot of headquarters are moving to. And if you think about millennials and those that choose to rent over buy, they will also choose to be in places that they can afford. And certainly the Sunbelt markets are affordable.
Your next idea, American Homes for Rent, AMH, on the New York Stock Exchange.
So one of the realities of the crisis was, we at Vision were able to buy companies that previously were too expensive at big discounts to net asset value, and American Homes for Rent is one of them. They are one of the largest owners and operators of single-family residential homes for rent in the United States. Previously, it used to trade at a premium to net asset value. Today, it trades at arguably called a 15% discount to net asset value. They're in 35 markets across the U.S., about 52,000 homes. What we like about the markets they're in, they have 3 times the population growth as than the national average, and 2 times the income growth of the national average. And if you think about the consumer psyche coming out of the pandemic, if they have the choice of renting in a high-rise apartment building or renting a home where they don't have to deal with elevators and the density issue, then they can be in a home with a backyard and in a good school district, they will likely choose that. And we think AMH is very well positioned. And on top of that, they have a tremendous balance sheet. That's really going to be their advantage. You want to focus on companies that have the appropriate debt profile in this environment and who can capitalize on the opportunities coming out of it as they perhaps might see distress, or they can simply go out and continue to build homes for their own rental pool.
And then your final idea, WPT Industrial, its warehouses are in the United States.
Yep. So again, a REIT that we think is mispriced, and mostly because it trades here on the Toronto Stock Exchange and not in the United States, though they're 100% focused on distribution assets, modern distribution assets in the United States. We like this company. It trades at a discount to net asset value, and we think there's quite a bit of upside. If you think about, I've been pretty negative on retail throughout this program. I'm very positive on industrial warehouse, and if you think about the statistics of you need 3 square feet for any e-retailer versus in a warehouse versus a brick and mortar retailer. Their needs in a warehouse. And with the rapid rise in e-commerce as a percent of retail sales, that's only going to increase the need for warehouse space. Plus, I think what's going to happen coming out of this is there's going to be a lot of inventory restocking and stocking up. I think up until now, a lot of retailers were doing a lot of just-in-time inventory, and I think there's going to be a lot more demand for space, and WPT has very efficient, new, modern warehouses that should benefit from this theme.
we are going to leave it there. Andrew, thank you very much indeed for joining us. Andrew Moffs has been our guest today, and he's with Vision Capital. Stay safe, Andrew. Just before we let you go, we've only about 30 seconds. How are you finding the new regime? People working from home, stuff like that?
That we're able to operate efficiently all working from home. But though what you do realize is how much you miss working as a team all together in an office space. But so far, so good. And thanks very much for having me on the program. Thank
you, Andrew. Okay, so before we go, let's close out the show with a quick look at the markets, and they are under pressure. We've seen the TSX, last time I checked, was down around 450 points. That's after a 4-session rally, or it's threatening to break a 4-session rally. North American stocks generally not doing so well, but of course they have been strong. What a rally we've seen from the lows of March. The Dow Jones posting a drop of around 400 points. The S&P too under a bit of pressure, down around 42 points. Turning now to crude, that has been moving to the upside insofar as the near-term contract even reflects reality in the oil market anymore. I mean, of course, that it's become so volatile amid fears among some market participants that near-term oil is still at risk of going negative as the actual delivery date approaches, the date on which long holders of the WTI contract are supposed to take delivery at Cushing, Oklahoma. There was an indication yesterday that US storage space may not be filling up as fast as investors feared, but still, it's a volatile situation. Last time I looked, there was strength in Western Canadian Select. It had traded above $10, but of course that tends to be an illiquid contract. Thank you very much indeed for watching Market Call. We'll be back at the same time tomorrow.